Welcome to the webinar. My name is Ben Russell, along with Jenny Taylor, Cassandra, and a few of the other team members in the background. Let's say welcome. Glad you're here today. Glad you get to be a part of this webinar where we're going to talk about some pretty timely subjects. Jenny, thanks for being on with me. You're going to be my co-host today. And, in that role, you get to kind of tell our friends a little bit more about how do they use our tools and how do they communicate with us? Because it's just not you and me talking. We want them communicating with us too, right?
Yes. So during the webinar today, we'd love for you to go to find that chat box at the bottom of the Zoom window there and let us know where you're coming from this morning in the United States, or maybe you're outside of the United States. I'm up in Minnesota, and I'm so happy that it's actually spring and summer. And all of a sudden it's like 80 degrees every day. And that's not even, we don't normally get 80-degree days till July. So we're all kind of like, oh, it's so hot now. Yes. And then if you do have questions, though, we would love for you to put those in the Q&A so they don't get lost in the chat. And then we might be doing a poll or two at some point today, but we'll explain that when we do that.
Very good. Well, Jenny, I think it's really important today that we talk about some interesting subjects, right? So many of us have this thing called a 401k. We don't even really know what it is. We just kind of let it sit there for a while, and maybe that's not the best strategy. So we're going to get into it. We're going to be able to talk about it. Again, that chat window is open. You can say, hey, I can see lots of friends from, let's see, we've got a lot of Texas, right? So we're in Texas. We're just outside of Houston. And by the way, Jenny, 80 degrees, that's a cool day for us here in Texas.
I know.
I can see lots of friends.
Because I lived down there for 10 years.
We got some friends in Arizona. 80 is probably a cool day for them as well. Colorado, California. Oh, sunny San Diego. 80 is probably like divine weather for you out there. Anyway, we're from all over the country. And so no matter where you're joining us from, glad you're here today. Thanks for being on with us.
Hey, one more point on the chat. If you guys see, you can actually change who you're sending it to. So some of you have already done that, where you switched it to everyone. Otherwise, you're just sending your comments to the hosts and panelists, which that's fine if that's who you want to send it to. But if you'd like for everybody to see your responses, you can switch that to everyone.
Now, Jenny, it's kind of funny, this GIF we've got over here. It's just a stock GIF, but you can see a guy with his phone. He's looking at his portfolio, maybe a stock, but what's behind that phone?
Well, there's a couple of things behind it. There's there's a computer with some more stock information or portfolio information on it. And then he's just got some $100 bills laying all over his desk.
Well, we're going to have a little bit of a conversation about it, but sometimes maybe it's a good idea for you to not have all those $100 bills invested in the market. A little bit of a clue as to what it is that we're going to be talking about here today. So let's talk about this thing called 401k. All right, well, sorry, the button didn't work. Let's try this one more time. At TRADEway, we like to leverage scripture as the core part of what we do. We believe that scripture provides for us the information that we can actually leverage to start to think differently than what the world would have us to think. And we think that that's actually prudent. All right, so let's read this proverb, Proverbs 27:12. A prudent man foresees evil, hides himself, and the simple, well, not so much. What they do is they pass on, didn't hide themselves, and they are punished. There's an axiom here where there is foresight, there is pre-planning, there's the opportunity for you and I to leverage discretion and wisdom to be able to do things differently than those that are not informed. Today, we want to talk about that. TRADEway has a different philosophy about how we would suggest that we can be prudent, that we can leverage scriptural knowledge, and how we can be those that are prepared and maybe have the capability of hiding during some pretty difficult times, as those that don't have the knowledge, well, they're punished. We don't want that to be you. So 2 Timothy is another great verse for us to talk about. All scripture, does it say some scripture? No, all scripture is given by inspiration of who? God. And it's profitable. Now, that word profitable, Jenny, it's interesting. It has this connotation. It's bringing an advantage. If it is not just about money, it can be, but it brings an advantage. And this doctrine, this teaching, these things that we learn, they're good for being able to reprove our behavior, and they give us proven standards. And what do we want to do with it? Well, we want to allow it to speak into our lives because we want correction. Correction is about restoration. By the way, if you haven't figured out the parentheses, that's like the expanded version, right? So when we're talking about correction, it's to restore or improve our lives or our character. And why? Well, for instruction in righteousness. And by helping us to fix our mistakes, then we can become more and more righteous. So it's not just in things related to our spiritual walk, it's in all aspects of our life that God uses and puts into us these concepts to allow us to be able to grow in who he's created us to be. Now, this next one, verse 17, take a look at this. That the man of God, the man there is not just a human man, like I'm a male, a human male. That term is actually the human race, so that all human beings are made of God, and that's us, can be perfect. Now, that's kind of an odd Hebrew term, so let's define when we say perfect. It's fitted with special aptitude. That one's interesting to recognize that perfection is an ability in some ways. It's a function in some ways. When we say perfection, there's a capability of behaving or acting with special attitude. Thoroughly furnished, that's an old King James way of saying completely ready. You're not unsure. You're completely ready to take action. Action in what? Into all good works, business, employment, entrepreneurial enterprises, whatever it is that you decide to undertake. So Scripture gives us a lot of these things that we can begin to apply into our lives. And because it says that the prudent are prepared, we want to leverage that verse. And we want to start talking about what I could potentially do, act with some prudence, to be prepared when it comes to this thing called the 401ks. So knowledge, receive knowledge rather than choice gold. This is one of our favorite verses at TRADEway. Receive knowledge. It's through knowledge that you can preserve and even potentially create your wealth. And wealth is a lot more than just gold. By knowledge shall your chambers, my chambers, be filled with all pleasant and precious riches. Vinny, the last time that I looked at that statement, it really doesn't say my bank account. It doesn't even say like I'll have gold. What it is, it's precious riches. Precious riches, just money? No, it's lots of things. It's all those things. Money is a part of it. But can I tell you that as you start to learn how to apply knowledge, you begin to recognize that money is not the end of it. Money is just a tool that we leverage for all of these things that we want in our lives to become possible. All right, so let's get into the knowledge part of this, Jenny. And by the way, again, if you got some comments out there in chat, you can go ahead and make those. If you got questions, that Q&A box is open. And let's start getting into some of the things that we want to be able to learn. We're talking about how can we be prudent? How can we gain some knowledge? And let's lay out a little bit of the groundwork about why. Okay, so here's something from LPL research. The average recessionary bear market lasts 14 months and has a 34% decline. It's sometimes difficult for these terms, but we see that thing called recession. Recession is not a very easy to define thing, but it has to do with the declining economy. It has to do with the government saying that things aren't growing. Have we officially hit a recession yet?
We have not. We did see, I can't remember what quarters they were, but we did see 2 quarters of negative GDP, which is gross domestic product, right? And that at some points has been deemed as a recession, but other indicators at that time weren't also flashing a recession. So currently, no, we are not in a recession yet. There's a lot of people that think maybe Q3 or Q4 we will be moving into that. What can you explain here real quick? What do you mean by average recessionary bear market? How is that different than just a bear market?
Oh, that's a great question. I tell you what, I'm actually going to cover that on the next slide because what I'm going to do,
perfect.
Jenny, I'm actually going to show you what does the market look like over time, and I'm going to show you when did the recessions happen. So that's a great leading question.
Okay,
so
good.
let's talk about one very interesting decline. Increasing monetary supply often is part of some of our deepest, most difficult recessions. Mm-hmm. So you and I, Jenny, we go get loans, banks give loans, the government gives loans, It's all about how much money is in the system. And usually when money is flowing in the system easily, pretty bullish for the economy.
Yes.
It's pretty bullish for the stock market. When you see decreasing monetary supply, when you see money getting hard to get and bank loans hard to get, and the government not being as generous in how much they're willing to lend out, well, that's when some of the deepest crises have happened. 2008 is a perfect example. And in 2008, our portfolios declined in average. Well, let's just say some portfolios were greater than 50% down from 2008. That's a substantial number that I think I want to be able to not be one of those that just lets it go on by. I want to be one of the prudent people, that can figure out how to take action beforehand.
Hey, and real quick before you go over this slide, I was just say, like, right now with what the Fed has been doing with raising interest rates, but also then decreasing their balance sheet, they are restricting and decreasing the money supply that is available. So we really haven't even started to see the effects of what they have done for the past like 10 months or so of interest rate increases.
You got it. And that's an important part of what it is that we're trying to talk about here, is that once you've gained knowledge, you begin to understand there are some things that we can be prudent about. We can actually look at as indicators of when we may want to start taking action. I'm not just letting those things happen to us in our portfolios. Jenny, before we get into some of the declines, I want to talk about first, let's talk about the good side of the market. The S&P 500. That's just what's listed here. You can see it's going all the way back into the 50s. It moves up, then it moves down, it moves up, then it moves down. But on average, microtrends helps us with a very interesting number. If you take all the years and average them together, on average, you can expect, on average, a 6% year-on-year increase on the S&P 500. 6%, that's great to kind of know, because now, Jenny, I can actually begin to start making some decisions about 6%. Keep it 6% in mind, because now I want to create a comparison. That average 6% increase on an annual basis, notice it kind of goes up slowly. What about the down moves? Well, the down moves, and this is the question you asked me, the strongest, deepest, most difficult down moves happen in these gray bars. Look at what happened to the market in the gray bars. Those are some pretty steep declines. Those are some massive decreases in portfolio value that just so happen to coincide with the things that we officially call a recession, where the economy is not growing, where the stocks that you and I buy as a part of the S&P 500, their earnings are not growing. And what happens is during these recessionary times, the market gives back an awful lot of value. It gives back an awful lot of value. So the greatest decreases, they happen during the recessions, and they happen for protracted periods of time. The width of the bar shows how long did that recession, how long did that decline last? And you can see some of the biggest declines happened when there was more recessionary pressure than not. Interesting graph, isn't it, Jenny?
It is. And it will be interesting to see what happens. You know, I see the 1980s there, right? And that's when we were having the stagflation.
Correct.
And it's just interesting to know, like, you know, I mean, who knows if it's going to be a huge crash or more of a let's kind of meander sideways, kind of up and down, swinging up and down. But even then, it's still not as easy of a market when it's like that to invest in.
Good stuff. So if we know these things happen, why would we just buy and hold, especially during these protracted periods of decline? But here's another view of that same data. And if you've not seen this slide is the reason why we do what we do at TRADEway. Bear markets through history have been very damaging to portfolios. Take a look. The blue bars down here, how much has the average decline been? How much was the decline during these time frames? What time frames? Here's the time frames: the 50s, the 60s, the 70s, the 80s. Just notice they happen every few years. That's really the key takeaway. They happen every few years. And the blue bar, how much did the market go down? The dark blue, how long in months did it take to go down? And then here's the one that I really think is important, Jenny. Look at how long it took to get back your money. That golden color, it's how long did it take to get back your gold? So let's take a look example at 2007. For 17 months, the market went down. At what point during 17 months do you think maybe you might have gotten a clue? Okay. After 17 months, the market had bottomed out after losing 56% of its value. And then after losing 56% of its value, it gained it back, and you got back to even 49 months later. Wow. At what point during the 17 months or this 49 months do you think maybe you might have figured out that you needed to do something different? Friends, that's a long period of time, and we think that buy and hold is really dangerous. And we'd like to ask this leading question: how different could your portfolio, your 401k, how different could it look on the number of dollars in the account if you just acted with some prudence? And you avoided these huge declines and decided to do something a little different than what the world would advocate. Why it's so important? Look at how hard it is to make back your money. If you lost 50% of your funds, you have to get 100% ROI to get back to even. What if you didn't lose as much and you still were able to get those huge increases that typically happen at the beginnings of the bull markets? Friends, the thesis is think carefully, avoid those big drawdowns. They're right. The average advice, Jenny, this is what we hear all the time: buy and hold because it's always going to come back. I mean, historically, they're right. I mean, we can look at this chart.
Yeah.
It took 9 months to come back, 56 months to come back, 49 months to come back. It comes back. What if you didn't take the big draw and then you were able to take advantage of those coming back opportunities? That's the thesis we want you to think about. That's the wisdom we want you to apply. Now, this next statement's going to be a little tough. It's very much against the current market. The current market is unusually hot, which is not abnormal, just before some very difficult things start to happen. David Mitchell, founder and CEO of TRADEway, he shared with us as a team, he shared with many of our clients, the market of 2022, he does not think it's actually over. We have yet to see a recession, right? So if I go and I look 2022, notice, Jenny, there is no 2022 on this chart. What about the bear market of 22? I don't know yet, right? And if I look, 27% is what it has gone down. So if I draw in that 27% line, that's how it compares to an average. 34% is actually the average number. Interesting that in 2020, that's what we saw. 2022, 27% is what we got to. And we don't really know what the number is going to be yet because we haven't really even hit a recession yet. And most people think a recession is coming. If we do hit a recession, then that 34% number is still very much historically in play. And if we have anything related to systemic issues around our economy, around the debt ceiling, around our inability to pay our debts, around the bank failures, well, let's just say that things could get a whole lot worse. What if we have another 2008 crisis? That would be a 56% decline. So David, others that have some experience under their belt, some grayer hairs where they've lived through these times and they know how they invested and how it impacted them. Friends, they're saying that we're probably not done going down. And if they're right, well, then that thesis would say that it's probably a really good time for us to learn how to act with some prudence and to get protective. So the odds of a recession, I pulled up this article, Jenny, I thought it was very interesting. So just went out and I did some Google searches. What's the odds of a recession? It's a pretty good odds, right? If you look at it, here's a Bankrate article. I found 5 or 6. This is the one that I just thought was, I liked the cover of it because it's got Silicon Valley Bank, SVB, for those that haven't heard. And as we're recording this in 2023, June of 2023, just a couple of months ago, there was a pretty significant banking crisis related to SVB, Silicon Valley Bank. And the Fed stepped in and basically backstopped the bank to where they made good on all the deposits associated with this bank. It was a big deal, and it caused a lot of turmoil in the economy. Now, you couldn't necessarily see it now because the stock market seems to be, raging higher. The question is, if we haven't yet hit a recession, and we do hit a recession, and the odds of us going into a recession are pretty high, well, then maybe we need to start thinking differently because of the charts that we've already shown. It's during a recession that the largest declines in our portfolio historically occur. What's it all related to? It's what actually caused the problems at Silicon Valley Bank. Jenny, this is a technical term. It's not something that we often hear, but it's called an inverted yield curve. Inverted yield curve. What is that talking about? Just a fancy way for the economists to talk about something that doesn't make any sense to us logically. Jenny, they're actually paying more money on the rates for us to get short-term bonds. So for example, we can get a short-term bond for 5%. And the long-term bonds are only paying 3.5 to 4%. Does that make any sense? I mean, a short-term bond, 5%, and then the long-term bond is 3.5 to 4%. Does it make sense to anybody out there?
I don't think it does. It shouldn't be that
not
way.
Make any sense, because normally you should be paid more for that longer period of time. Could you put your screen on the right corner? If you go, Sherry, if you're talking about me being in the way, you can actually press escape and you can change your view for how you see me displayed. So this inverted yield curve where you are paid, you know what, Jenny, I'm wondering, let's try something different here on the view. I want to actually change. Does that change things on your side, everyone, to where you can actually like see our pictures? It's not going to change it for you, Jenny. It's going to change it for the audience.
Oh, okay. Yeah.
Do you like that view better? Where you can actually read the screens?
We have people saying yes.
Okay, perfect. So this inverted yield curve where you are paid more for a shorter term rate, it does not make a lot of sense. And what you will see is over time, we can go back in history and we can see where was the yield curves inverted and for how long. The 50s and the 60s, it was inverted for a very long time, and then it dropped. A very short period of time, came back up. Oh, that's interesting. Jenny, were we in an inverted yield curve for a very short period of time? Yes, we were. Market came up, and then the market tanked after a protracted period of being in an inverted yield curve. This could be very similar to what we're looking at right now, by the way. Happened again, big steep decline. Happen again, inverted yield curve. Look how long it was inverted. Huge decline. That was after 2000. And Jenny, we've been in a protracted period of time now where this yield curve has been inverted. About how long, Jenny, have we been in this inverted yield curve situation?
It's been 10 consecutive months at this point, and generally between 9 to 12 months is of it starting, of the inverted yield curve like beginning, is when you will start seeing the recession start. So that's why I'm thinking, maybe Q3, quarter 3, we might see it start.
That's not very far away, is it? So that 10-month time frame where we are right now, it's normally that 9 to 12 months is when we begin to see these inverted yield curves really kicking in with the economy. And the thing that I believe is actually going to be a little more damaging is because right now the Fed has raised interest rates 10 times faster than any other period in history. And there's actually a lot of speculation they're going to do it one more time. And that's exactly what caused all the problems with SVB, Silicon Valley Bank. And other banks are actually being suspected of having similar issues. Why? Because if they have to raise capital, what they need to do, this inverted yield curve is what's going to kill them. Leading question. I have a bond that I bought 3 years ago, and I'm getting paid 1% interest on it. Who wants to buy a bond from me that still has 2 years of time on it for 1%? Who wants a 1% bond from Ben? Anybody interested in a 1% bond right now?
Not when they can buy it for 3 right now, percent, or 3.5%, or whatever it is. Everybody's like, pass, no.
Exactly. All right. So here's the issue. All those banks have bonds on their books. And if they've got to raise capital, how do you raise capital? You go sell assets. And if you have all of these bonds on your book and you've got these assets where nobody wants to buy them, what do you have to do to get someone to buy an asset? Somebody doesn't want to buy the asset. What do you have to start doing to be able to get people interested in buying the asset?
Lower the cost.
Oh, so I have to start lowering the price. That means in our terms, it's called discounting. I have to start reducing the price that I'm willing to sell it for to be able to raise the capital. And it's exactly what is happening to so many of these banks. They don't have the ability to just hold the bonds. They've got to be able to sell them. And when they go sell them, they have to sell them at a loss. And it's those losses that are causing a lot of the runs on the bank that we have been seeing over the last few months. And there's a lot of us that think that we're probably not done with that problem. It's probably going to come down to the crisis in the real estate market, where the commercial real estate all has to get refinanced, and it's starting to come due, and they're all going to have to go refinance at much higher rates. A lot of that's tied in with bonds. I'm just saying there's a lot of very difficult things still coming down the pipeline in our economy. Time for us to get prudent. All right. So can we be prudent? Can we be prepared? Will this knowledge help us to protect our wealth? Can we find some way of being prepared to act ahead of time? If we know recessions and bear markets happen every few years, why not find a way to get defensive? And that's really what I want to focus on. I want to talk with you about some of the ways. I've hopefully laid out a case for you that says you want to think about how to get defensive. I've laid out a case that I think is compelling. I want you to think through that. You just want to be one of the individuals that lets the market do what the market's going to do without any sort of prudence? I would suggest you want to be one of those people that acts with prudence instead, and you're prepared to take action. Look at your benefits. All right, so your 401k. On your 401k, look at your benefits administration portal. Now, this is a little interesting because some of us have never even really logged into our benefits administrator portal. All right, so when you log in, you're going to see all kinds of interesting things. If you don't know how to log in, then you need to contact your benefits administrator, get some help with logging in, and figure out in advance what are some of your investment choices. Who gets to choose your investment choices in your 401k? Help me out there in the chat window. Who gets to choose what you're interested in? It's you. You choose what you're invested in. You choose what you're invested in. Now, the problem is that there's lots of choices out there. There's lots of choices, and what you're going to discover is that most of the time, there's not a lot of clarity on what asset classes are available to you, and there's not a lot of clarity about what are some of the ways in which maybe you could reallocate your capital into things that can help protect you in a downturn. What I'm going to suggest, find out in advance what your 401k offers. Find out in advance what opportunities you have to move your assets into something that can better weather the storm. And if you don't know, call your benefits administrator. Ask them this question. Is there a money market or interest-bearing fund option? Now, money market's not something that a lot of our friends know what it means. What's a money market?
Good question. So money market funds are what our cash in our accounts, like let's say our brokerage account that we may have, when we aren't invested in stocks or ETFs or in options, whatever, it's getting swept into a money market fund. It's not just sitting in your account as cash. It's going to be earning a little bit of interest in that money market fund. So again, that's for brokerage accounts. You may or may not have that option within your 401k or 403b. We would have to,
Well, that's why,
you'd have to actually ask them.
You got to find out from your 401k what's available for you. And then what we're suggesting is that you may want to learn how to read the cycles of the market and position your accounts based on those cycles in the market. When things look to start getting dicey, move to lower risk instruments such as money markets. And as the indicator starts to show that we're going into a recession, you normally want to try to move out of those risky positions, those things like stocks, as you get close to a recession, simply because of the declines that we historically see during a recession. Happen every few years. Why not try to be prepared for that?
Larry has a question here. Is a money market the same or similar to a cash sweep account?
Typically it is. So when you look at cash sweep, that's usually going to be quote unquote swept or moved into a money market. Normally that's only available when you're in a brokerage account. your 401k is probably not going to use a cash sweep vehicle as the way in which it describes that methodology. And that's the reason why you got to work with your benefits administrator to find out what your 401k offers, because candidly, I want you to see that first bullet point. Every single 401k is different. There is, I mean, you can have an account at Fidelity with your employer, and your neighbor has an account at Fidelity with a different employer, and they've got completely different programs, completely different offerings. It's your benefits administrator, it's your company that determines what funds are available to you. Not a TRADEway thing, it's your company that limits what you can do. And if you look, there's lots of things that are bullish. There's lots of different mutual funds, lots of different opportunities for you to be invested in bullish markets. But when it comes to bearish, not so much, really. I mean, there's very few things that are designed to be able to help protect you during those bearish market cycles. And Jenny, there's this next thing that I want to be very interested to talk a little bit more about: bonds. Bonds, right? So many times people are like, bonds are the safest thing. Financial advisor would say, especially as you get a little older, you want to go ahead and put all your money into bonds. Not always a good idea.
It's not always a good idea, and bonds can actually become like, you may not get actually paid. It's not guaranteed. It's a promise to pay. But if the company you bought the bond from, or maybe like if you bought a city bond, for a city or a municipal bond, if those go bankrupt, they may not pay the bonds back. Even just now with the whole debt ceiling discussions that have been going on, they're talking about, that there's the potential we could default on the US bonds. Now, will that ever happen? I don't know. I doubt it. But like, they're even kind of saying, they're not as safe as they have been in the past. So bonds can be an issue if we don't understand all of that, all of the risk that is there.
Right. And so someone's saying, what about gold? If you've got gold as one of the opportunities inside of your 401k, that's great. But we'll tell you that not all 401ks have that sort of opportunity, Erica. So if you're looking at your investment funds, you would have to figure out, what does your 401k offer? There are times when you're in recessionary periods where things like gold can be a very strong performer. All right, so we want to be cautious of those things called bonds, just because they're not always as safe as what we think they are. And Jenny, there was a headline not too long ago about this very small little bank over in Europe. It was called Credit Suisse. Credit Suisse, or Suisse, depends on how you want to enunciate that. Credit Suisse. They had over $17 billion in bonds simply wiped off their books when UBS took them over. When they were in a banking crisis, and this is just a couple months ago, over $17 billion of bonds just evaporated in value and expired without any value whatsoever because the company went bankrupt. That's pretty crazy. Be careful. Bonds are not as safe as what people think they are. So instead, let's consider how to think like a trader. Now, Jenny, I think that this guy's outfit is a little odd. I don't know if he was like a
Christmas.
Yeah. All right. He's a little different cat, right? He's dressing a little differently. Well, we want to think a little differently than the world. Consider going in quarterly and thinking about, what do you think the market's going to do next? What's the next quarter? Look at the cycle. Look at where we are within the economics. Where are we from a perspective of GDP growing and shrinking? What do we think this next quarter is going to potentially look like? And then consider switching your investment choices to match up with that projected cycle. I'm going to suggest this: kind of force yourself into action. Create a calendar invite just before the end of every quarter. Go in and set a review cycle for yourself. Review 401k. Go in and look. How have your investments done? What is the next quarter looking like? How are my 401k funds currently invested? And keep this in mind. Most of the time, the market's bullish. Most of the time, the market is bullish. And most bull markets happen 3, 5, 7, sometimes as long as 10 years. But most bear markets are pretty short. They are not as long as what the bulls are. So your bias, my bias, is usually going to be bullish. Usually it's going to be bullish. But it's the abnormality is when we're in these bearish cycles. And at TRADEway, what we do is we look at the technicals, we look at the different types of charts that show us when we begin to see warning signs that technically the market is likely going to roll over. And then we look at things like news. And when we see things like news showing that we're probably moving into a recessionary period, we start to see signs the market is getting a little top heavy or even a little too bullish. You can actually start to proactively think we're probably due for a recession. We're probably due for a correction. And when you have a correction that's combined with a recession and slowing economics, that's when corrections often turn into bear markets. But let's just be proactive about it. Let's ask ourselves the questions on a quarterly basis. What do I think the odds are that this next quarter could be a recession? Jenny, if I ask myself that question right now, here I am in Q2 2023. What are the odds that next quarter is a recession?
I would say higher than this quarter. I don't know exactly what it is, but I would think higher than what it is right now or what it was in the Q1.
This could be a really good time for us to start thinking about, how do I get defensive? And am I prepared to take action and to think like a trader? Because we could be coming into some really difficult times. Be prepared, be prudent. Why? Well, I think it's pretty interesting. This is from Money Manager. I don't necessarily want to say their names. I don't want to have any sort of, let's just say that this is a marketing slide. Building your wealth slowly, building rock upon rock, upon rock, upon rock, upon rock. It's so much better than really building it fast, then losing it fast. Well, hold up a second. Jenny, we started with one rock, had 9, now we've got 4. Actually, doesn't look too bad to me. And then build it fast again. Well, what is this advertising even telling you? That you've got the capability that you could probably build your money pretty fast if you had some skills. But it's so much better to just build it slowly and let us make money off of you than you figuring out how to do it yourself, figuring out how to do it and then losing it and then retiring. Well, their advertisements give you an awful lot of data if you just look behind the scenes. The problem is, if you build it slowly and then you have a recession that hits and you have these huge decreases to your portfolio, what if this is what happens to your portfolio? Well, you might lose your toupee over it. Friends, it doesn't have to be that way. So why buy and hold when you recognize that these charts, the wisdom that we can see based on the past, tells us that being prudent and not being in the market all the time can dramatically help change our long-term results. So if you want our help, why don't you consider joining us with a program called Ampt, A-M-P-T. A-M-P-T. That's advanced, I'm sorry, Jenny, I sometimes forget. AMPT is Assisted Managed Portfolios by TRADEway. Yes, it's a difficult acronym. We had to think very hard to be able to come up with it, and it still doesn't roll off my tongue quite as easily as what it should. But it's TRADEway's assistance managing your portfolios with TRADEway's knowledge. And our investment advisors, that would be people like me, people like Jenny. We're here to try to help you to create a plan to help you to preserve your wealth. And if you leverage our services, you can do it with a part of your funds. So let's say, for example, you've got an old 401k somewhere or an IRA that you want some help managing. You can move that into our advanced program, our Ampt services. And when you do that, you're also going to get our advice along the way. And what a lot of people do, Jenny, I think this is really smart. They actually leverage our Ampt services, our Ampt alerts, and then they go take action on their own 401ks. And again, they get to choose what they put it into. They consider the opportunity to get defensive when we're defensive in how we're managing the funds. And they get all that information off of the Ampt communications. So how does this work? Well, most programs are limited in their bearish options. They do not have allocations typically that help you to get defensive. But what if you could move your funds out? Here's the question that you ask. You call your benefits administrator and you ask them this question: how much can I roll over to an IRA? That's the actual question right there. How much can I roll over to an IRA? And if you can roll over to an IRA out of your 401k, then consider letting us help you with it. We offer the service to help you with being able to protect your long-term funds. We invest it with the cycles of the market. We have different investment choices, not just on the bullish, but on the bearish side. And our minimum investment is 10,000. Jenny, why do we suggest 10,000?
We suggest 10,000 because it allows us, when we do get into our bullish portfolios, it allows us to actually be diversified across the different sectors and industry groups. If it's less than that, we may not be able to, it may not be a large enough of account to purchase something, the shares in like one specific sector or two or so forth. So that's why we do have that minimum investment.
All right.
And I do see, well, I think somebody grabbed it, but we can also help you in regular individual brokerage account, joint brokerage accounts. It doesn't just have to be your retirement accounts as well.
Okay, so by doing this, there's one other really key factor. We talked about money market funds earlier and how sometimes you can move to those things that pay you an interest rate. And Interactive Brokers has a very interesting opportunity. So Jenny, you and I, we think that there is a very interesting TRADEway axiom at play here. What's the phrase we like to use at TRADEway?
We like to use that cash is a position, and that is why.
Say that again. Cash is a what?
A position.
Oh.
Cash is a position, not just being constantly invested in something, right?
All right. So when you and I want to be able to defend and protect, 4.58% is what currently is being paid on funds that are not invested, that are a part of the Ampt TRADEway program. Interactive Brokers, the brokerage partner that we have that helps with your funds. When we're invested in the market, we can trade through their platforms. When we're not invested, we can have it in their money market fund, and it's currently yielding 4.58% annually. Vinny, that seems like a pretty high rate. How are they able to do this?
Well, they are utilizing very short-term treasuries, U.S. treasuries, and that's how they're able to have such a high yield compared to your bank account making, I don't even know, 0.5% or so. So that's another thing that actually will end up happening is as the Fed increases these interest rates, it allows places like IBKR, Interactive Brokers, to be able to pay out this, and people will actually start shifting their savings accounts from their bank accounts, and you'll see these massive withdrawals from that, and it will flow into these high yield money markets funds at places like this.
So wait a minute.
I also wanted to hit, okay, go ahead.
Increasing rates like this that pay people like us more money when we've got our money with them actually becomes a little bit of an incentive for people to even get out of banks. Is that what you're saying?
Yes. You'll start seeing that. It's already been happening. And it will continue to pick up. And here's the thing about this specific, about IBKR in particular, is that this rate that they're paying right now is connected to the Fed's fund rate. So in June, actually we're in June. Can you believe it's halfway through the year already? I can't. But we think there's a lot of people that believe the Fed will probably increase by another 25 basis points or 0.25%. And what will happen is this rate will actually jump here. The 4.58 will actually jump by that same 0.25%. It will increase again. So it's tied to that Fed's fund rate. And what's great is right now with the interest rates high, it's paying this good interest on balances that are over $10,000.
That's why we think cash is a position. This is a riskless way for us to be defensive in times when we think the market is probably going to roll over. And what I think is really interesting, Jenny, and I kind of want to close out this topic here, is recognize that with the right knowledge, you can have some opportunities to be able to take advantage of things like cash being a position at 4.58. That is a riskless return. And it's very easy for us to click a button and go to cash. It's very easy for us as a part of the Ampt program to click a button and get invested in the market. And we as a program, what we do is we try to time the cycles of the market. Now, it's not perfect. We could have a few weeks to a few months where we're not invested because we're waiting for the trends to be confirmed. But how much peace of mind does it bring to know that you're getting that 4.58% on your cash. Brings a lot of peace of mind to us as your investment advisors, I'll tell you that. All right, Larry's got a question. I'm sorry, Jerry. So I still work for my company. Can I roll over to an IRA? Jerry, that's a great question. Right here, the answer is maybe. The answer is maybe. Right? Call your benefits administrator and ask them how much can I roll over. And the reason why I'm asking you to do that is because sometimes the answer is, hey, whatever you've contributed, Jerry, you could roll over that. Sometimes if you're 59 and a half, for example, or older, sometimes the answer is, hey, you can take as much of it out as what you want to. Because every 401k program is different. I need you to find the answer to that question. Call your benefits administrator and ask this question. How much can I roll over to an IRA? How much can I roll over? Okay. So what
One
is
more thing I
Ampt
wanted to point out. Can I point out just one more thing? One great thing about these money markets paying these types of interests, you can tell it's slightly less than what like the 3-month or 6-month bonds, treasury bills or treasury bonds are going for. But you're having to and that's an annual rate on the bonds. That's not paying you like 5% or 4.85%, whatever it's at right now. That's not just paying you for those 3 months. It's the annualized rate. And then your money is tied up for that, at least the 3 months. If you're trying to get that full rate, then you would be tied up for a year. What's great about the money market funds is that it's just sitting there and it's ready and available, because you never know, like, okay, we go into the bear market and we go into the recession, have more moves down. Well, when that new bull, we think that new bull is about to start, you don't want your money being tied up in a 12-month treasury bond or an annuity or something like that. You want to be able to be ready to be invested in stocks and really good ETFs and that stuff. And that's what is so great about the money market fund. It allows us to have the money making good interest right now, but be available for us to invest at the click of a button, like Ben said.
It is. It's as simple as us clicking the button to be able to change our portfolio. So let's talk a little bit more about some of the benefits that Ampt members get. Well, Jenny, you just said one that's not even on the list. Your money is in a brokerage account, ready for us to be able to act. And Interactive Brokers is one of the strongest of all the brokerages because of how they manage their funds. There's a question here. What if IBKR goes out of business? That's a great question. So IBKR has a FDIC insurance. That's the federal deposit and the federal deposit, whatever IC stands for, I don't remember, but that's the insurance that we all get. Does anybody know how much insurance you get on your account? If you go down to your bank, they say FDIC insured up to what? $250,000. Well, what Interactive Brokers does is they leverage 10 different banking partners in the background. And what happens is they give you the ability, without you even having to do anything, your funds are split. So if you have 1.25 million, you're going to have 10 different banks in the background helping you to protect your assets to the FDIC insured levels. They do that automatically. So if IBKR starts having a problem, FDIC insurance helps kick in. And because they're leveraging 10 different banking partners, you're insured up to $1.25 million. Great question there. Thank you for that one. And that's not even on the list of the benefits. I think maybe I need to add a few more benefits here. So helping to protect your funds is a big part of what we do. I think you've already heard some of the ways in which we do that. We very much don't want to ride those markets to the bottom. When we are in bullish cycles, it's really important for us to still have diversified portfolios. We're going to help you with being able to get access to that 4.58. And as the rates go up, if they do go up in June as expected, that 4.58 is going to go up as well. And you're going to get frequent updates from our team, helping you to understand why and how we're making the investment decisions that we are. Lots of questions, Jenny, in the chat window about how our friends can take next steps. So if you would, please, can you go ahead and pull up the poll for me?
Yes, I was just typing one last answer. Make sure I do the right one here.
So for those of you who want to take next steps with us, why not meet with us? People like myself, Jenny, David Verbugen, what we do is we help answer your specific questions. We're registered investment advisors, and our goal with that meeting is to help you to create a plan. Our goal is to try to help give you access to an advisor, which many of you don't even have access to an advisor. You don't have someone you can call and ask a question to. Why not schedule a call with us? And if you want to do that, it's as easy as you answering this poll question. Jenny, why are we doing this poll question? What's the process that's going to happen here?
Yeah, so there's actually two questions. There's the first one asking roughly about how much money do you think you'd be interested in bringing into the Ampt program? And the reason why we ask that is so that we can have the upfront costs and what the management fees, just the fee structure correct for you when we meet with you. It's to help prepare your investment advisory rep for your meeting. And then the second question there is just if you are already working with one of us, go ahead and select who you have already, maybe you've already spoken to one of us, the advisors, about this in the past. So that's, oh, and then I think you also meant that if you answer this poll, then you will also receive an email specifically from one of us that with a scheduling link for you to select a day and time that works for you to meet with us to discuss your specific situation.
Really the key, Jenny, is that by answering this poll, you're saying, look, I'd like to engage with you. We will send you an email that has that link and you can meet with one of us. And it really is about helping to answer your specific questions on your specific situation. And what we want you to also get a little bit of a flavor for is that investing is different than trading. And Vinny, there's people that ask us, hey, can you trade for me? And up until just recently, the answer was no. Now we do have something that we can help our friends with. It's called the Ultra Portfolio. Is there a little bit of a pun at play there with the Ultra Portfolio?
Well, yeah, Ultra Portfolio can be shortened to up and then Ampt. So we've got it called Ampt Up.
Well, it sounds like maybe we're a little excited about that program. We're a little amped about it. And the Ampt Portfolio, puns intended, friends, it's how we can help you with some of your funds to be more actively traded. And you can talk with our investment advisors about that opportunity as well. We would suggest that no more than 20% be invested in this very aggressive risk tolerance. It's designed to be a small portion of your funds, but we pretty actively trade it. We've done some credit spreads. We've even done some things on like the VIX. We've done some pretty interesting things inside the Ultra Portfolio, haven't we, Jenny?
We have. We've even done some cash secured puts. So we've
Wow.
done. There's lots of opportunities for us to be able to be a lot more active in that portfolio than one would be with long-term investments.
So investing is more about preservation, more about those assets being secured and invested when it makes sense in the market. But what about trading? Well, that's what the Ultra Portfolio is designed to do. A small portion of your assets more actively traded with more speculation than just the investment part of your portfolio. Schedule an appointment with us. We'd be happy to tell you more. So what's next, Jenny? Well, I think we just have to just say thanks. Thank you so much for spending your time with us. If you're watching this as a recording, thank you for spending your valuable time being able to learn more about why and how we think as investment advisors. We do think protecting your assets, it's your responsibility to do that. And we asked the question sort of at the beginning, are you ready for a market crash? We hope that what this investment advisement has helped you to see is that there is a different way of thinking, and that you can actually be prepared to help to protect your 401k. And if you want some help, we can help you with it. You can go to tradeway.com/ampt. That's right here, tradeway.com/AMPT. If you're watching this after the fact, you can schedule an appointment there. You can always send us an email, ampt@tradeway.com. For those of you who are live, you clicked on the poll questions there. The poll is still active. If you have not yet had an opportunity to be able to click on it, by clicking on those buttons, you're letting us know that you would like for us to contact you. Oh, Jenny, we did have that one. Do we have to only do retirement funds?
Oh, no, we can help with individual accounts. We can actually help with entities like businesses, S corps. We can help with trust. I mean, that's why we want to be able to meet with you, is to discuss the different accounts that you guys currently have or maybe in the process of creating, and so that we can really get down into those details so that we can specifically help you with your situation. And Yeah, and we have somebody asking, can I make a withdrawal? And really what's cool is you are in control of your account. If we're the ones managing the funds, you don't have trading access. But if it's an individual or joint account, you get to link your bank account to it and transfer money in and out, just like you would for your regular trading account that you may have. And then for those of you that have retirement accounts and have to take your required minimum distributions, you can actually set up where that's just done automatically. So there are ways, yes, that you'll be able to withdraw funds from your accounts that would be in the program.
Excellent. Well, that pretty much closes us out, and it looks like the question board is clear. So thank you all so very much for being here today. And again, if you've got questions, visit us tradeway.com/amp or email us amp@tradeway.com.